Now, the situation in Syria is taking its toll on oil prices, or boosting them is really what we should be saying. Look at those numbers. Oil surging nearly 3% today here in the United States on concerns that the U.S. may be inching closer to a potential military strike on Syria, perhaps as early as Thursday, Kelly.
Bill, Peter Schiff is saying this is bad news for an already sluggish U.S. economy, while David Hale of David Hale Global Economics doesn't see an immediate economic threat. So, Peter, first to you. You're never super optimistic here, but you're saying this really makes things worse?
Well, it depends on your perspective. I own a lot of oil. But, you know, I thought oil prices were going to go up anyway. I think clearly the catalyst for a $3 move today is Syria. But if it wasn't Syria, it would have been something else. Oil prices are going a lot higher than $109 a barrel, and it is a big negative for the U.S. economy. And what's happening right now in Syria is just one more weight on a weakened economy, and we can't bear the weights that we have, let alone the additional weights that are being placed upon us.
David, why don't you think higher oil prices would hurt our economy right now?
I think if we had a large oil price increase, that would be a negative. That would bolster inflation, depress real income. That would be a problem. What's unclear is why the Syrian conflict should lead to sharply higher oil prices. Syria itself 2 years ago produced only a couple 100,000 barrels of oil. It's not a factor. The real danger posed by Syria is it lies in the region where a lot of oil was produced. It's a conflict in some ways between Iran and Saudi Arabia. If they had a direct conflict, that would obviously mean much higher oil prices.
You said you'd be concerned if it got much higher. How much higher before you start to get sweaty palms about the economy?
$20 a barrel, $25 a barrel.
And you think we're going that higher, Peter?
Well, I think ultimately, we're going to move to $110 to $125 a barrel relatively soon, maybe in the next few months, maybe sooner if something does break out. But I think over the next few years, oil is going to take out the $150 a barrel high that we put in prior to the 2008 financial crisis and work closer to $200 a barrel. But it's not because of Syria. It's because of Ben Bernanke and whoever his successor may be, because of Abe in Japan, because of all the central banks around the world that are just printing too much money. It's quantitative easing. It's inflation that is causing oil prices to rise, not the other way around. And I think, you know, when the Fed gets a good look at what's happening with oil prices, what's happening with stock prices going down now, real estate prices now turning south, corporate earnings going down, I think the employment picture is going to darken. I think this is another reason for the Fed not to taper, which ultimately might be what saves the market from a bigger decline, is going to be all the new inflation and the fact that the tapering talk is put back to sometime next year. And then again, they'll come up with another excuse why they can't taper.
Peter, of course, whatever support that brings will be offset by the impact, by the cuts that higher oil prices will have. It will effectively mean that for the broad middle and lower classes of Americans who don't necessarily have stock investments that benefit, that they're going to see a standard of living shock. I just want to ask, if what you're saying about oil prices heading to $250 a barrel is right, why, if anything, does the market keep telling us that it sees prices lower the further out we look into these contracts?
Well, first of all, I said up to 200. Maybe it'll go to 250. I don't know. But I thought 150 to 200. But yes, Americans are going to suffer a declining standard of living. That is the consequence of quantitative easing. That's one of the reasons I'm opposing it. The Fed is destroying the standard of living of middle-class Americans by destroying the value of their savings, of their wages. And yes, prices are going to go up. But look at oil companies. I own a lot of oil stocks. And oil companies aren't really making a lot of money. Look at oil stocks. They're not going up. $100 a barrel is not high enough for these oil companies to economically replace their depleting reserves.
Right,
it tells you that oil prices are much too cheap. Inflation is driving up the cost of exploring for oil. Oil needs to be $150 to $200 a barrel for these oil companies to make decent profits.
I'm just saying, why is it, if you're saying that oil is going to 200, do the forward contracts reflect an oil price that's lower than where we are today?
Because the consensus is wrong. The consensus is wrong about a lot of things. The consensus is wrong about gold. They've been wrong about the bond market. Remember what people thought about internet stocks in 1999 or about real estate in 2007. Okay. Whenever you have a consensus, it's generally wrong. So I'm not looking at what most people think is going to happen to the price of oil. I'm looking at what I believe is going to happen to the price of oil, and I think I'm a better barometer than just a consensus opinion, which has historically proven to be wrong far more often than it's right.
Very good. Gentlemen, thank you both.